Hello everybody, Dr. Phil here. So this is going to be a video on financial analytics. So how data analytics and business analytics is used in the realm, if you will, of the area of finance. So let's start off by talking about what is finance. So finance is the management of money or financial capital by investing, borrowing, lending, budgeting, saving, and or forecasting. So financial capital, or simply capital, refers to the economic resources that companies use to operate their business. So, for the most part, money. So, let's talk about some branches of finance. So, corporate finance is the function in a business that manages funding sources, capital structure, and investment decisions with the goal of increasing the value of the firm for the shareholders or the owners. Investments is a branch of finance that focuses on acquisition and disposition of assets with the objective of generating profit or income. Examples of financial assets include equity investments, common stock, US Treasury bonds, corporate bonds and commodities. So, for example, oil and wheat, it's gold. Financial markets and institutions. So, financial markets are the markets for selling various investments, including stocks and bonds, commodities, and derivatives markets, selling various types of investments. So, that could be the NYSE, New York Stock Exchange, the NASDAQ, the Chicago Board of Options Exchange, the CBOE. And then financial institutions work in financial markets such as banks. So think about like Bank of America, Wells, investment companies. So think like pension investment firms like CalPERS, and then brokerages. So like Goldman Sachs and Merrill Lynch, some of those investment banks. All right, so moving on. So some examples of finance questions by analytics type. So if we were thinking in the context of in the realm of descriptive analytics, maybe what's the return to investing in the stock market over the previous 5 years? For diagnostic analytics, an example question could be how well did the corporation perform relative to its budget? For predictive analytics, will a potential borrower repay their loan based on credit score, payment history, existing debt, etc.? And for prescriptive analytics, what happens to Bank of America profits if the interest rates on its loans change in the future from, say, 3 to 4 to 5% or more? So here we see financial data analytics with respect to the different types of finance questions in the main branches of finance, the three main branches. So just to pick a couple of examples here, if we look at say descriptive, what happened. So corporate finance, what was the company's return on investment for investments in the international and domestic divisions last year? Investments could be, what is the return on investing in the stock market or the corporate bond market over the previous 5 years? And then for financial markets and institutions, what is the sum of real estate loans made by banks in Illinois during the past 6 months? And then if we look at, say, prescriptive, which of course that's the context of like what should we do based on what we expect will happen. So if we think about it from the standpoint of corporate finance, in that context, which assets should John Deere invest in? A new piece of manufacturing equipment or new supply chain software? For the standpoint of or the context of investments, what are the expected returns to different financial instruments given the expected risks? And then for financial markets and institutions, what will happen to the probability of banks in the US if interest rates increase by 1%? Now, those primary financial data sources are as follows. So stock return data, which you can get on like MSN Money, Yahoo Finance, MarketWatch, Reuters, etc. Summarized financial data from the likes of Bloomberg, Reuters, of course, financial statement data. You can get it from corporate websites, SEC filings through Edgar, and then XBRL, Extensible Business Reporting Language. So there's plenty of financial data available to get if you want it. So here we see descriptive analytics, which characterizes, summarizes, and organizes features and properties of the data. So if we just pick a couple of these, let's talk about, say, counts. Of course, shows how frequently an attempt occurs. So the example of the type of finance question, it addresses how many companies have gone public, had what's called an IPO, initial public offering, in the past 6 months. And then graphs and bar charts, the use could be to show performance graphically. What are the levels of quarterly profits over the past 3 years shown in a bar graph? And then here we see, there's obviously a lot of information here, descriptive statistics for three possible investments. So the S&P 500, which includes dividends, the BAA corporate bonds, and then US Treasury bonds. And of course, for each, we've got the mean, the standard error, the median, the mode, etc., etc. So again, a lot of data here. This is where you almost get to the point where it's kind of like TMI, too much information, maybe TMD, too much data, and you need to find ways to really kind of pull out the meaning that you're looking for, if you will. So as far as defining diagnostic analytics, we kind of break this down into two broad categories to help determine why something happened. So the first is identifying anomalies and outliers, so something different than we expected, and finding previously unknown linkages, patterns, or relationships between variables. And to do that, we might think about performing drill down detailed analytics and perhaps performing statistical analyses. With respect to identifying anomalies and outliers, typically comparing the actual to the expectation or perhaps the benchmark. So here we can see Walmart Inc. We can compare it to the S&P 500 index, and then we can also compare it to the S&P 500 retailing index. So we're able to see at a glance kind of how they did. Here we can see if we go back real quick, we've got again 2017 through 2022. Sort of same thing here. We've got the data. I would say that I would submit to you that this is probably easier to read, right? The old saying, a picture is worth 1,000 words and all that, than just sort of, look, if we're kind of going back between the two, you can probably tell me which one's easier to read. And most likely we would agree it's this one. Drill down techniques and tests. Uncovering the details by summarizing the data at different levels. So an example question that we could use that would help us with might be, which customers included in the total accounts receivable have the highest balance outstanding? And then a diagnostic test example could be, sum all of the accounts receivable by customer and then sort the total accounts receivable balances by customer from highest to lowest balance. And then if we think about, say, regression, assessing how a specific dependent variable outcome value is related to independent variable inputs. An example of the type of question that could address could be, how are R&D expenditures related to future firm profitability? An example of a diagnostic test could be to run a regression analysis to assess the relationship between R&D expenditures and net income. For hypothesis testing, we could maybe do that using a difference in means. So the question might be, are the returns to an investment in stock greater than an investment in bonds? And then hypothesis testing using regression. An example could be, are returns to different investments associated with the risk they entail? So is the risk basically commensurate to the return? So this kind of shows you, the risk and return kind of continuum, if you will. Treasury bonds and bills, low risk, low return. CDs, low risk, low return. So as you're kind of moving up towards the right, the risk's getting higher, but the return is also increasing. So investigating the relationship between risk and return. If we were thinking about it from the standpoint of a regression, then we would probably set our dependent variable to be investment returns and likely set the independent variable to be different measures of risk. So the dependent variable could be different measures of expected investment return. So for example, past stock prices or returns, bond yields, or returns on real estate investments. The independent variables could be different measures of risk. So for example, we may look at past stock price volatility, volatility of earnings, the beta, bankruptcy risk, also known as default risk, and perhaps the level of debt, also known as leverage. We could also introduce what's called CAPM, Capital Asset Pricing Model. And this is a model used to predict the relationship between systematic risk and expected return for financial assets. So the three predictive analytics techniques are classification, regression, and time series analysis. So what can a bank use to predict whether a borrower will pay back their loan? So one is, of course, is credit history. Does the borrower have any delinquent accounts where the payments are late or behind schedule? What is the borrower's monthly credit card bill? Does the borrower have any unpaid collections accounts, medical bills, for example? Has the borrower declared bankruptcy in the last 3 to 5 years? How many recent applications have been made for credit? How much total outstanding debt does the borrower have? And what is the debt to annual income ratio? What is the borrower's credit score? A statistic that evaluates a customer's credit worthiness and ability to repay a loan. And do they rent or own their home or condo? So this, it's not a total list, but it's exhaustive. But these are some things that would likely be asked. With respect to income, what is the borrower's annual income? How long has the borrower been employed at his or her current job? Is the income verified? Does it come from self-employment or is it from salary? What is the salary history? And then loan specifics. For what purpose is the borrower intending to use the loan? And how big of a loan is the borrower requesting? So here we see some examples of predictive analytics addressing some of these financial questions. So if we pick, say, regression, right, a predictive analysis technique used to predict a specific dependent variable outcome value based on independent variable inputs. So the type of question it addresses would be, can we predict the interest rate given to prospective loan borrowers at a bank? And the type of test might be that we decide to run a regression analysis to predict the interest rate given based on prospective loan borrower's characteristics. So that's just one example there for you. For prescriptive analytics techniques, we could use margin or incremental analysis. This is a technique used in finance to determine the change in profit associated typically with the cost or benefit of selling, buying, or making the next, or the margin. We call that the marginal unit. The cash flow analysis, evaluating future cash flows using various analytics techniques, including NPV, net present value, and internal rate of return, IRR, for potential investments. Scenario analysis is an analysis of potential future events by considering potential outcomes. Goal-seek analysis is a type of what-if analysis that tells us what will need to be done or assumed in order to reach a desired outcome, output, or result. And sensitivity analysis speaks to evaluating the outcomes based on uncertainty regarding the inputs. So here we see some examples of prescriptive analytics addressing finance questions. And just to pick, say, one, let's go with, say, cash flow analysis. So this evaluates future cash flows for potential investments or expenditures, typically using NPV, net present value, or internal rate of return, IRR. So the example finance question could be, what are the expected returns to investing in a corporate bond or stock? And the specific technique employed would be estimate the amounts, timing, and risk associated with the predicted cash flows of a new financial investment. All right, thanks as always for watching, and I will see you all in a future video. Take care.